Welcome back to RegTalkUK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation. I'm Alex.
And I'm Jamie.
So, what do a political bloodbath in Westminster, £1 million voluntary payment by commodity traders, and an autonomous artificial intelligence have in common?
I'd say they're all quietly rewriting the rules of UK banking compliance this week.
Spot on. Let's set the scene for you. Britain is currently sweltering in an absolute heat wave, but frankly, the real temperature spike is happening over in Westminster. Keir Starmer has resigned following a devastating set of local election results.
Yeah, which is just, it's a massive political earthquake. And now, through a highly strategic by-election in Makerfield, Andy Burnham is essentially packing his bags for Downing Street.
Right. But before we get into the fallout of that, we do need to state our usual disclaimer. We are looking at this purely through the lens of market impact and regulatory ripple effects.
Absolutely.
We take absolutely no political sides here on the deep dive. Our focus is strictly on the fiscal realities, the numbers, and, well, how the market is digesting this sudden leadership flux.
Because the bond markets are, frankly, actively choking on the news. They're scrutinizing Burnham's proposed borrow for growth agenda, and the reaction is severe.
Yeah, we are hearing serious chatter in financial circles about the return of the moron premium.
Right, and for those who might have mercifully blocked out the Truss and Courtang episode, the moron premium is, well, it's the risk surcharge that gilt investors apply to UK debt when they simply do not trust the underlying fiscal maths of the government.
Which makes sense. You have to remember the broader context here. Investors are looking at a proposed borrowing spree against a grim macroeconomic backdrop where the UK already pays the highest borrowing costs in the entire G7.
Exactly. I was reading the Andrew Neil report earlier, and their assessment was brutally succinct. They stated that Burnham's honeymoon will be, quote, over by Christmas. Yeah, and that creates an immense tension for our listeners, because while the political flux is creating massive macroeconomic uncertainty,
the regulatory train never stops.
It never stops. There is a raft of Prudential Regulation Authority and Financial Conduct Authority outputs that simply cannot wait for the Westminster dust to settle.
And we are also seeing AI governance reaching an absolute tipping point, which we'll get into later. But let's start with the immediate fiscal nudges emerging from the Treasury, because they are going to demand a total overhaul of retail banking products.
They really are. The Treasury is reshaping the ISA tax landscape, and the policy intent is incredibly blunt. They are attacking cash hoarding.
Let's walk through the actual mechanics of these changes for you, because they are aggressive. First, there is a new 22% tax on cash interest held within stocks and shares ISAs for anyone under the age of 65.
And that takes effect in April 2027, right?
Yes, April 2027.
Yep.
And second, they are slashing the annual cash ISA allowance from £20,000 right down to £12,000.
Wow. So the underlying logic here is essentially an anti-circumvention measure. Historically, people have used non-cash ISAs simply as a tax-free parking account.
Yeah, just leaving it in cash.
Exactly. They leave their capital in cash within a stocks and shares ISA, earning interest without actually investing it. The Treasury wants to penalize you for sitting on that liquidity.
So they are forcefully nudging under 65s to push their capital into the stock market, specifically to funnel retail cash into UK equities and startups.
Right, but to balance that out, they have introduced the new first-time buyer ISA, the FTB ISA, which replaces the old lifetime ISA, or LISA.
Yeah, the FTB ISA. They've removed the upper age limit of 40 for new savers. They are keeping the 25% government bonus, and crucially, they're removing the 25% withdrawal penalty if you use the funds for something other than buying a property.
But I really have to challenge the actual utility of this new FTB ISA. Let's look at how the maths actually works for the consumer on the ground.
Okay, lay it out.
The 25% bonus is only paid out at the point of property completion. Yes, if you withdraw the money to buy, say, a car instead of a house, you don't get hit with the old 25% penalty.
But you also don't get the government bonus.
Precisely. So if the bonus is entirely locked behind a house purchase, what is the actual point of this account as a general savings vehicle? It functions more like a political gimmick masquerading as a liquidity solution.
That is a completely fair critique. But let's look at what this means for you listening right now. If you are sitting in a risk or compliance function, this fiscal shift is an absolute conduct risk nightmare under the consumer duty.
Oh, without a doubt.
You have a fiscal landscape that is actively, forcefully nudging retail savers away from cash. If you are a bank, you now have an immense duty of care. You're going to have vulnerable retail customers who historically just wanted the safety of a cash ISA.
Right, and now they are suddenly looking at 22% tax penalties and panicking.
Exactly. They will feel compelled to invest in complex equities just to protect their returns from taxation.
Which means the bank is caught right in the middle. Imagine a scenario where a risk-averse customer is essentially nudged by these tax penalties into a complex investment product. Maybe something like a natively tokenized fund that they fundamentally do not understand.
And if the market dips and they lose their principal, who does the FCA hold accountable?
Well, it won't be the Treasury for creating the tax penalty, I'll tell you that.
No, the banks will be entirely on the hook for failing to ensure good consumer outcomes. Product disclosures need a total overhaul well before April 2027 to explicitly map out these new tax implications. Otherwise, the mis-selling claims are going to be astronomical.
Absolutely. And while retail banks are distracted trying to map out this new ISA conduct risk, they are about to get hit with a completely different structural hammer from the PRA.
Yeah, because while Westminster is busy playing musical chairs, the technocrats at the Prudential Regulation Authority are quietly engineering the long-term stability of the UK financial system.
Right. Their annual report for 2025-26 lays out the blueprint. The PRA has finally cemented the implementation of the Basel 3.1 standards.
And we have a firm date now, right?
We do,
Yes.
January 2027. Notably, though, the market risk elements are being delayed to 2028. This is specifically to ensure alignment with international peers and prevent regulatory arbitrage.
And alongside that, the Financial Policy Committee actively lowered the banking system's capital benchmark from 14% down to 13% of risk-weighted assets.
Yeah.
For those of you outside of prudential risk, what is the actual mechanism at play there?
Well, risk-weighted assets are essentially a way of measuring a bank's assets based on how likely they are to lose value. By lowering the required capital benchmark from 14 to 13%, the FPC is sending a massive signal.
They are saying the system is resilient.
Spot on. They are stating that the systemic resilience built up in the UK banking sector over the last decade is holding strong. Lowering that requirement frees up a significant chunk of capital, which banks can then use to support lending and economic growth without taking on undue systemic risk.
But, the part of the PRA strategy that I find most fascinating isn't the capital requirements. It's how they are fundamentally changing the way rules are made in the first place.
Ah, you mean the cost-benefit analysis panel.
Yes, the CBA panel. They are adopting what they call the critical friend mandate.
And this represents a profound shift. Historically, regulatory policymaking worked in a bit of a vacuum. A regulator would design a policy, write the rules, and then conduct a cost-benefit analysis at the very end.
Right, just to justify the decisions they had already made.
Exactly. It was post-hoc policy testing. But the CBA panel has completely inverted that model. They are now embedding the challenge into the early-stage gestation of the policy.
It is basically the difference between doing a safety inspection on a car after it has already rolled off the manufacturing line versus putting the inspector on the assembly line itself, checking the parts before they are bolted together.
That's a great way to put it. They are evaluating the causal chain of evidence, connecting regulatory actions to firm behavior before the draft is even finished. And to accomplish this, they are leaning heavily on the standard cost model, or SCM.
Let's unpack the SCM for a moment, because this is the ultimate antidote to industry lobbying. In the past, when the PRA proposed a new rule, firms would routinely respond with wildly inflated estimates of how much compliance would cost them.
Oh, constantly. It was a defensive tactic aimed at killing the regulation. Just firm, regurgitated waffle and panic.
Regurgitated waffle, exactly.
Right.
The SCM changes the game entirely by providing a transparent, validated toolkit. It uses external views and industry-validated benchmarks to estimate what compliance should actually cost.
Right. So if a bank claims a new data reporting rule will cost them £50 million to implement, the PRA can run that requirement through the SCM and counter with, well, actually, our validated benchmark says this should cost your specific size of institution £4 million.
Show us your raw data.
Exactly. It forces firms to provide evidence cooperation. You can no longer just throw out scary numbers and hope the regulator backs down.
It is a brilliant system. But reading through the fine print of that 2025-26 annual report, there is a hidden vulnerability that compliance teams really need to be aware of.
Go on.
It involves the Enforcement Decision-Making Committee, the EDMC. This is the functionally separate body that actually decides on contested enforcement cases. They are essentially the impartial judges within the Bank of England's ecosystem.
Okay, and what is the specific vulnerability there?
The report highlights that the EDMC is currently seeing all of its originally appointed members reach the end of their terms this year. All of them.
Wait, all at once?
Yes, all at once. You are swapping out the entire technocratic guard people with immense experience simultaneously. It's like changing your entire coaching staff right before a cup final.
That is a massive loss of institutional memory.
Exactly. That is the kind of quiet vulnerability that nobody pays attention to, right until a highly complex market abuse case falls apart because the new committee lacks the continuity of experience to navigate it. If you're finding this useful, don't forget to follow RegTalkUK on Spotify or subscribe on YouTube. It really helps us reach more banking professionals like you. So speaking of the EDMC judging contested cases, let's look at how firms are actively avoiding those tribunals in the first place. Because the FCA had a very busy week regarding market integrity and innovation.
They certainly did. The most revealing case was the FCA's competition probe into 11 commodity traders over information sharing and coordination.
Yeah.
What makes this enforcement action remarkable is how it actually concluded. The traders offered a £1 million ex gratia payment to the Crisis and Resilience Fund, a purely voluntary payment.
I am still stuck on this £1 million payment. The FCA explicitly noted that this voluntary payment likely exceeds the statutory fines that could have been imposed under their strict turnover-based caps.
It does.
Why on earth would 11 incredibly cutthroat commodity traders voluntarily overpay the regulator?
Because they are buying closure and they are buying goodwill. The FCA has effectively created a premium tier of enforcement.
Right.
By offering this voluntary ex gratia payment, these firms avoid a drawn-out, highly public tribunal that drains resources and, frankly, damages reputations. It is a pragmatic, albeit expensive, fast lane to closure.
So they are demonstrating to the FCA that they take market integrity seriously and are willing to go above and beyond statutory minimums just to make things right.
Precisely. So they're paying a premium to make the headline go away quickly. It's a fascinating precedent for legal teams to look at.
But the FCA wasn't just focused on enforcement this week. They also greenlit a massive piece of market innovation. They approved Baillie Gifford, alongside BNY Mellon, to launch the UK's first natively tokenized authorized fund.
This is a huge milestone for wholesale markets, but we should probably clarify what natively tokenized actually means in practice because it can sound like heavy jargon.
Yeah, please do.
Instead of traditional fund accounting, the fund is handled end-to-end on a blockchain. This means there are no middlemen manually reconciling ledgers, and there are no 3-day settlement periods.
The fund's ownership is instantly verifiable on the chain.
Exactly. It proves the FCA is willing to embrace frontier financial technology, provided the governance and the consumer protections are demonstrably robust.
But, and this is the kicker, if your governance isn't robust, the PRA is waiting for you. This week, we saw them hand down a £1.785 million fine to Barron's Reinsurance's London branch.
Yeah, the failure there was a breach of operational readiness for the temporary permissions regime after Brexit. It is notable because it's the first time the PRA has fined a pure reinsurer.
And they didn't stop at the firm level. They also pursued individual accountability, issuing a £72,000 fine for George J. Hambro.
He was a former notified non-executive director at Wyland's Bank, right?
Yes, exactly. He was fined for failing to act with due skill, care, and diligence in his oversight role. So when you look at the commodity traders voluntarily paying £1 million to fix an issue versus Barron's Reinsurance and Wyland's getting publicly hammered for operational failures.
The synthesis is crystal clear.
It really is. Regulators are telling the market that outcomes matter far more than defensive PR. If you find a problem, fix it proactively, pay up, and improve your systems. Proactive remediation pays. Defensive stonewalling just gets you dragged through a public tribunal and fined.
And that concept, proving that your systems are safe rather than just reacting when they fail, that segues perfectly into the most pressing operational risk sitting on bank boards today. We have to talk about artificial intelligence.
We do. We are witnessing an absolute explosion in agentic AI, and it requires a total abandonment of outdated governance models.
We need to define the terms carefully here, though, because agentic AI is a massive leap forward from the generative models people use to, say, draft emails.
Yeah, we have moved way past simple automation or a chatbot summarizing your account balance. Agentic AI takes autonomous action on the consumer's behalf.
Right.
It can initiate payments, approve credit lines, or execute complex advisory decisions completely without a human in the loop. The operational upside for retail banking is staggering.
But the downside risk is equally severe. We are talking about hidden bias, algorithmic hallucinations, and discriminatory lending patterns executed at lightning speed. Regulators globally are waking up to this reality.
Look at the gating influence coming out of the United States right now.
Yeah.
The U.S. administration is treating frontier models, things like GPT 5.6, as dual-use technology.
So how does that dual-use classification actually change the day-to-day compliance checks for a UK bank?
Well, dual use essentially means the technology has both commercial and military or severe security applications. By classifying these frontier AI models as dual use, the U.S. is demanding government-supervised release and rigorous security sign-offs before the models ever hit the open market. So if the U.S. government is treating an AI model with the same security-first rigor as national security assets, UK bank boards absolutely cannot treat it like just another routine software update.
That makes total sense. And this technological shift is creating absolute carnage in the professional services sector. The consulting crash is very real. Look at Accenture. Their market value has halved since the start of 2024.
Halved.
Halved. The consulting industry is being gutted because AI is ruthlessly exposing its reliance on routine, commoditized advice. If a firm's business model relies on charging thousands of pounds for generalist thought leadership or drafting standard policy documents, an AI agent can do that in 3 seconds for fractions of a penny.
So the market for generic knowledge is effectively expired.
Entirely. Value has shifted completely away from creation and toward granular rigor and statutory oversight.
Which means if you're sitting in a risk management meeting tomorrow, you are probably going to hear third-party vendors promising that their new AI tool is, quote, consumer duty compliant out of the box.
Oh, yeah.
Do not believe them. Here's the new rule of the game. Bank boards must maintain a complete, documented AI inventory. You need to know exactly where every model is operating, you need documented human override points, and you need hard-coded kill switches.
Absolutely essential.
Let's just walk through a 30-second scenario. An autonomous AI is handling your mortgage approvals. It hallucinates a correlation between a specific postcode and default risk, effectively redlining a neighborhood and denying 1,000 vulnerable customers a mortgage.
A total disaster.
You get hit with a massive discrimination lawsuit. You cannot turn to the FCA and blame the third-party vendor. The old Silicon Valley mantra of adopt first, govern later is absolutely dead. The era of evidence of control has officially begun. You have to prove the algorithm is safe before it ever touches a customer's finances.
That is a stark warning, but an important one. Let's bring all of this together with a rapid-fire recap of the week. I'll do strictly one sentence per major story.
Go for it.
First, political flux is bringing the moron premium back to the gilt markets as investors scrutinize the new leadership's borrowing agenda. Second, the Treasury is actively penalizing cash hoarding with aggressive new ISA tax limits and a 22% tax on non-cash ISA interest.
Yep.
Third, the PRA has definitively cemented the Basel 3.1 implementation timetable for January 2027. Fourth, the FCA's commodity trader probe proves that proactive remediation and voluntary settlements supersede statutory fines. And finally, agentic AI has officially killed the adopt first, govern later mentality, demanding absolute algorithmic auditability.
Brilliant. So what matters most for you, the compliance, risk, and legal teams listening right now as you head into the week ahead? Number one, your ISA product disclosures desperately need updating. You have to map out the new customer journeys before the April 2027 tax changes kick in to avoid a severe consumer duty failing.
Right.
Number two, the Basel 3.1 roadmap is final. The debate over timelines is over. Implementation must accelerate now. Number three, bookmark that commodity traders ex gratia payment. It is a vital precedent for legal teams on how to effectively buy closure and goodwill from the FCA when a breach occurs. And number four, absolute AI auditability is no longer optional. You need those kill switches documented immediately.
And I will leave you with a final, slightly terrifying question to ponder this week. We have established that agentic AI is moving toward autonomous customer financial decisions, moving money, executing trades, altering portfolios. If one of those autonomous systems eventually commits market abuse, who exactly does the FCA hold accountable? Is it the third-party vendor who trained the model? Is the bank board that deployed it? Or in a truly autonomous system, is the liability somehow held by the code itself?
That's all from us this week. Thanks for listening to RegTalkUK. Until next time, stay sharp and stay compliant.